I want to be in safe haven assets. I want to be in underpriced safe haven assets at this point in time. People are rapidly going to move and are beginning to, and you can see this in the outperformance of the Dow versus the NASDAQ, for example, that people are going to take risk off the table. They're going to care more about the return of their money than the return on their money, the classic Mark Faber argument. And for that reason, I think gold is the only one-way trade in the markets right now. It used to be the Japanese yen carry trade. It is no longer. And so the big one-way trade is gold. Gold has nowhere to go but up because everyone on the planet, from the Federal Reserve down to you, has an incentive to own gold and want a higher gold price.
Really good segue for this next question, Tom. Last week, Russia, they announced a 700% increase in gold purchases. This is 1 month before the coming BRICS summit. It's also 1 week before the Western powers started talking about it being acceptable that U.S. manufactured long-range missiles were allowed to be used to strike inside of Russia. But are all these actions, are all these actions coincidence? Are they coordinated? What is Russia's announcement about this gold increase purchasing? What is it really telling the world? What's really happening here?
It's like the Russians aren't dumb. They run a $8 to $10 billion a month trade surplus. Like, I hate to break it to people, but they make a lot of money. And then they buy a lot of gold with it. And they want, and remember, everybody's betting on China because China's the big economy to run the post-Western world, right? Well, but the Russians aren't dumb. They have a very they understand their place in the world, which is that they have a very adolescent financial system, and they need to grow it. And they need to grow it rapidly because they already are they're going to be the go-to country for so many natural resources in the world, and they won't have the crux and the crutch of the existing dollar-based system to liquefy that trade. So they're going to have to build that from scratch. It's part of what the unit's about. It's part of what the BRICS Alliance is about. And that means they have to deepen and strengthen everybody's trust in the Russian financial system. That's a tall order, folks. I mean, I'm a big fan of what Putin's done for his country, but this is the next phase of how you rebuild trust with the world. So how do you do that? Well, hey, importing not only like Russia produces something like 250 or 270 tons of gold a year. I don't know what the actual number is this year. It could be 280, it could be 300, I don't know. But somewhere they're in the top 5 producers, and that's somewhere around 250, 300 tons a year. None of that gold leaves Russia. Let's just be frank and honest. Okay. Does it show up in the official Forex reserves? No. Does it show up in the official IMF reserves? Not necessarily. Does it show up in the Sovereign Wealth Fund? You bet. Does it show up unofficially in other areas and other stuff on other people's balance sheet? Yes. Same thing with China. China's sitting on probably 10,000 more tons of gold than they cop to. Why? Because they're going to need that gold in order to attract the capital necessary to liquefy the system, the financial system that they're trying to build. So it's not really that tough because then they're going to have to issue actual currency, rubles or yuan or whatever, for people to actually trade in. But it's backed by, and if it's in some way convertible to gold, that's interesting. Now, that's what the unit's for. It's an international settlement of claims against sovereign gold, which everybody will get together once a quarter, and they'll make a big shipment of 50 tons of gold from India to Russia, or from this one to that one, and then it'll just sit on their balance sheets, or they'll use it as a basis and a bedrock for writing derivative contracts like everybody else does, and using that by which to do development loans and that's what's going to happen. That's what this is about. And so Russia's saying that they're going to increase their imports of gold by 700%. Well, how much were they really importing before that when they're already buying all the domestic production? I don't know. Does it matter? But it's a lot. And it's yet another way of pushing like Russia's not stupid. They understand that all the trading in the West is done by headline sniffing algorithms. Okay. So Reuters writes a headline on Tuesday saying that the oil market's going to go down. Oil goes down. On Thursday they write an article that says the exact opposite, literally what they just wrote on Tuesday, and the oil prices go up. I wonder who wrote those headlines.
Mm-hmm. So, Tom, you stated before that the U.S. debt issue can be easily solved. Gold just needs to be at a higher price. So, how high does gold really have to go to solve the U.S. debt issue? It's pretty massive.
I don't have an answer for you. What I'm going to say is this: the question isn't gold taken by itself. The question is going to be what we, as the users of the dollar, will decide is the right ratio of national gold reserves owned by the central bank and the value thereof versus the size of the Fed's balance sheet. Let's just call it a number. I don't know what that leverage ratio looks like, but let's talk about it today. A $2,600 gold. I mean, I can't do the back of the envelope math off the top of my head, and I really should do that one of these days so I have it fresh in my head to use in one of these podcasts. But I think it's like $600 billion, right? 8,133.5 tons times $2,600 an ounce is what? $600 billion. The Fed's holding it on its balance sheet at $11 billion, which is hilarious and silly. But what's the Fed's balance sheet? Somewhere around $7 trillion, $7.5 trillion. So what's the ratio there? The leverage ratio there is around 11 to 1. Let's just call it 11 to 1, even if the numbers aren't quite right. It could be 12 to 1, it could be 14 to 1. It doesn't matter. The question is, what's it got to get to restore our trust in the system? 3 to 1, 5 to 1, 2 to 1, 1 to 1? I don't know. I have no idea. I'm not that smart because I know I may be a smart guy, but the room is smarter than me, and the room cares, and the room will make the decision. Not I won't make that decision. The market will make that decision. So could the price of gold rise by 4x and then cut that leverage ratio down to 3 to 1?
Is the market in the process of making that decision as we speak?
I agree.
Starting the process?
Absolutely. That's why Powell's been aggressively shrinking the balance sheet. That's why he stopped. Again, go back to Danielle Booth. She said this 8 months ago. She's like, Powell will give up rate hikes in order to allow QT to tick along in the background. Why? He's trying to shrink the balance sheet of the Fed relative to our hard collateral to recapitalize the bank. It's not that freaking hard. So you got one or the other or both. He did both to start out with. Now he's doing one versus the other. He may cut mildly, but as long as he can still keep shrinking the balance sheet, he's okay with that. And if he's got the Bank of Japan keeping the offshore dollar markets, the leverage within that system tight or low, continue to tighten it, he can cut interest rates and alleviate pressure on the domestic economy while still screwing the globalists in the global economy. Like, it's a win-win, folks, but you have to start thinking like, well, okay, how am I going to do this? Well, I got that guy Ueda over at the Bank of Japan. He's my butt. And the Bank of Japan has always been the Fed's wingman. It's always been a wholly owned subsidiary of the Federal Reserve. So if you have globalists at the Federal Reserve, then you're going to have globalist policy from the Bank of Japan. But if you have a sovereigntist at the head of the Federal Reserve, you think you're going to get a sovereigntist over at the BOJ? I think so. Which is why Kishida is not running who was Kuroda's right-hand man all those years. Kishida deferred and said, I was kind of the architect of this old monetary regime, right? I'm not the guy to lead Japan into this new era. And he deferred. In Japan, an entire society obsessed with seniority.
Yeah. So, okay, that was amazing. I really liked the way you positioned that whole thing. Let's shift over from central bank over to retail here for a second. Data from the World Gold Council, it shows that physically backed gold ETFs have seen global inflows rise for 4 months in a row. And tucked within the data, America has outpaced Europe and Asia over the summer. So is the Western financial advisor, and investor beginning to wake up to what's happening? And if so, what does that mean for the price of gold as more and more advisors and investors rotate assets into the gold space?
Well, let's put it this way. What did I say earlier about the two-tiered monetary system in the United States? What's being deprecated in terms of importance? The futures market at the LBMA and the COMEX. Inventories on both those exchanges are dropping like rocks. We're getting very close to the, if you're an old guard gold guy, you know what I'm about to say. If you know what FOA means, you know exactly what I'm talking about, which is that moment when the market, when we find out that the paper price of gold is not a clearing price for gold, and therefore that market goes bidless, and the COMEX is revealed to have no gold, and then therefore the price goes to zero. That doesn't mean the price of gold goes to zero. It means the futures price of paper gold goes to zero because everybody wants the physical. What are we doing? What I said earlier, and I did a podcast with Vince Lanci about this, I don't know, 3 or 4 months ago. And I urge everybody to listen to that podcast because Vince lays out all of it, why we're headed towards this. GLD and SLV are going to have gold custody, but they will not be convertible into gold. The COMEX, under that regime, if we don't want the gold to flow to China anymore, then we have to get rid of the physical gold settlement system where anybody can walk up to the COMEX, buy a contract, at the end of the month, take delivery, and then take it to parts unknown. We want to control that flow. How do you control that flow? You get rid of that market. GLD and SLV, you can redeem them, but you have to go through only large purchases, and they can only go through, the custodian, which in this case is now J.P. Morgan or HSBC. That's it. They're your trusted intermediaries. The federal government will sign off on whether or not that gold, that say 200 tons worth of gold that someone wants to redeem out of GLD and take to India or to 20 tons over to Hungary. And if the American government says, yeah, no, sorry, you get paid in cash. But you'll no longer be able to go to the COMEX and do this or to the LBMA to do this. It'll be a soft capital control on physical gold. So what are we seeing? What a shock. We're seeing the inflows into GLD because more people are using it for this reason. It's not for what you just said. It's because the COMEX and the LBMA have always been used as a means by which to the futures market, have been a means by which to speculate on currencies. When people need to hedge FX risk, they use gold. So traditionally, you use a gold futures contract in London or Chicago to do this. Now you're being told flat out, you got to use GLD. And so the gold FX speculation is moving to GLD, while the COMEX is being depreciated and deprecated to zero. That's the process. And the strategically why that is happening is because we no longer want the physical gold to go to China. Whatever we produce is going to stay here. Just like Russia, whatever they produce stays there. Whatever China produces stays there. Everybody's national gold production is going to become a important strategic discussion.
Let's talk about.
And then so commensurately, the volume on GLD and SLV have to rise in order to take on that FX hedging demand, and therefore they go out. GLD's got to go out and source a couple hundred tons of extra gold. But that's all. That's what that means.
Let's talk about the mining production. How do you see the rising gold price coupled with falling oil prices impacting the mining balance sheets?
In the short term, it's great, right? Because for once, I am no fan of the gold mining industry, even though I, like everybody else, I beat my head against the wall and try and, recommend a couple of them to people that don't have terrible management. I'm trying to be nice. I'm trying to be kind here. You have Rick Rule on the show. He'll just rant about this for 45 minutes. Like every time I listen to Rick talk about the lack of governance in the gold mining space, I just chuckle because he's better at it than I am, frankly. But in general, it should be very good, right? Low oil prices are going to flow, and high rising underlying, production prices, product prices should flow down to the balance sheets of a lot of gold miners really well. The problem for gold investors is whether or not management is going to get drunk and stupid and start buying properties like drunken sailors on Liberty, like this is what they always do. Another podcast with Vince Lanci where we go into that as well, and why most gold management teams don't really care about taking care of their shareholders. They don't. They just want a nice, easy relationship and let the bank do all the work for them to sell their product as opposed to taking care of it themselves. Now, whether the industry is changing or not, I will leave that caveat to the audience to do the work, because I don't follow it that closely, honestly. Remember, I'm a 40,000 foot strategic guy. These are things that I know inherently that what I just described may be out of date. The gold industry as a group may have gotten better at this, may want to actually take control over their own finances in a way that is far superior. And maybe this cycle will be different than the run up from 2008 to 2011, where it's amazing how gold price like friggin' triples or quadruples, and the mining companies still didn't outperform gold. Like a lot of good ones didn't outperform gold.
So there's been a lot of good discussion on this very topic, detailing how a lot of the companies have really cleaned up their balance sheets and have done a very good job compared to where they were. But that's not really for this discussion. So, Tom, let me ask you this question.
Actually, it is a little bit, Gary. I'd like to hear what you have to, because I don't follow it that closely anymore. So I'm okay with like editorializing
pull up some of the other folks that I've interviewed. They'll share their opinions on this topic. So, but I want to ask you a question on silver, and you could answer it from the 40,000 square foot view. It's fine. Tom, the AI revolution, the data center explosion, alongside the growth of EVs, solar panels, all the advanced military weaponry that's being created these days for what's happening, from what we spoke about, the electrification of everything around the world, it's raised silver demand annually, causing supply deficits for literally the last 4 or 5 years. Supply has remained relatively flat. It's somewhere in the 800 million ounce range. What do you see for silver, over the next 6 to 12 months or so in terms of supply and demand dynamics, silver prices? Are you expecting a little bit of a catch up here with gold having taken off, or the gold to silver ratio is awfully stretched?
The gold to silver ratio is actually, I hate to break it to everybody, the gold to silver ratio is actually quite normal right now. I have a 24-year chart of the gold to silver ratio on a weekly closing basis. Just took the weekly closing prices of gold, the gold to silver ratio, cash basis of both, charted it, did a linear least squares fit regression in Excel, and got a line like this. It's an upwardly sloping line because silver is still continuing to lose monetary character and rise as an industrial metal. All the things you just talked about. So,
but if you go back 100, if you go back to like,
I don't want to go back 100 years. 100 years doesn't matter. It was a different era. Back then, silver was money. Silver is not money today. Silver is an industrial metal. Period. It is. Like,
I'm not arguing. I'm just simply 50 years ago in the 70s, it wasn't
right,
either, but it was higher. It was lower.
Again, in the 70s, all the governments in the world were anticipating all this and were distorting all of their silver stocks in order to build the industries you're now talking about. Now, in that sense, start with the 24. It doesn't matter. Like I could probably build a 60-year chart and it would go from like 15 to 1 to 8 to the current level of 85 to 1. It would still be, have a lot of twists and turns, but at the end of the day, it's an upwardly sloping line as silver has lost monetary character. As a matter of fact, this is the chart I use to kind of prove Mises's regression theorem in the real world about how a commodity can either gain or lose monetary character relative to its industrial demand. Silver has lost its monetary character because of the immense uses for it in commodities. We used to use copper as money. Now then we decided to make weapons out of copper. Now all of a sudden we don't use copper for money anymore, right? Yeah, you know what I mean? Like and then we had electricity, and we needed all the copper to build, induction motors and all the rest of it. So my point being is this: my expected silver to gold ratio, just doing that simple calculation, which I just told you what it is. The expected silver to gold ratio is about 85, somewhere between 80 and 85. It's not at a peak. It's been kind of flatlining for the last year or so. The last couple of years, as a matter of fact, that flatlining is directly correlates to, I don't know if this has correlation causes causality, is indicative of causality, but Christine Lagarde putting the kibosh on credit spreads and holding everybody in a very tight current FX and bond yield regime. Very important. Maybe that has correlation, or maybe that has causality. I don't know. But until I see a spike either up or down in the silver to gold ratio, which is always, again, a lot of these things, it's best to look at, when you look at huge spikes and huge drops, they're usually indicative of a major turn in geopolitical events or policy. A major policy was put into effect, or a thing happened that altered the course of that market. I can do this with bond spreads. I can do this with the Dow. I can do this with gold to silver ratio, oil to gold ratio, all of these things. And when you start to like annotate charts, historic charts that way, you start to see the pattern emerge. So right now, silver is clearly underpriced. None of that. I'm not trying to like get around that. Silver is clearly underpriced. So is gold. The question is, which one of those is going to outperform the other and create the stretch in the opposite direction from where it sits right now, which is at a kind of equilibrium between 80, with a ratio of 80 to 85. A move back into the 60s would be interesting. A move up to 100 would be interesting, and of course would be the contrarian play. Meaning, if the ratio goes to 100, then you're buying silver and you're selling gold. And what I tell all my subscribers all the time is the fact is this: when you're near that expected ratio, you buy 50-50. If you're going to buy gold and silver at the end of the month, you buy equal parts. When it's above the line, you buy more silver than gold. And when you're below the line, you buy more gold than silver. And that way, it's a kind of dollar cost averaging thing. And then when you also remind yourself that, the bullion banks, the traders in the bullion banks like to manipulate the spread to their own, on a day-to-day basis, to their own, and the week-to-week basis for their own profit. So it's what's going to move the ratio sincerely from where it is now is going to be a major geopolitical event of some form or another. And it could be anything. There's 100 of them out there that could trigger it. So that's the big question. But EV demand is going to fall off. All the other stuff I'm on board with. I love silver, but I just want people to have rational expectations, meaning it could take 10 years to get to $300 silver. It could take a year. I don't know, because we may have other things happen first that preclude silver going to where it needs to go, and the money go into preferentially into oil or gold or some other asset class first. But I like to watch silver as a leading indicator. It's like, I call it, it's like Dr. Silver exists for the tech industry, Dr. Copper for the industrial economy. And that's the way I like to look at them. And for the most part, I shut down all other conversations about it. So, salt all of that rhetoric to taste.
I like that. All right. Well, this has been a wonderful conversation. And before we wrap up here and I ask Tom our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews just like this one that we conduct. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read on why everyone should own gold. So head over to metalsandminers.substack.com. Put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Tom as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. It's now time for our Golden Nugget segment. Tom, let's discuss portfolio positioning. Understanding that you're not a financial advisor, and based on all that we've discussed today, and with your experience and your worldview as your backdrop, how are you positioning for the next 12 months? What assets do you like? And maybe even more importantly, what assets do you absolutely want to stay away from?
Stay away from, sovereign debt is radically mispriced to the upside. Like bond prices are way too high. So I was early on my call to short T-bills because Janet Yellen, but if it wasn't for Janet Yellen, then my call on being long TBT would have been a good one. And I did. I made a call on TBT. I want to be in safe haven assets. I want to be in underpriced safe haven assets at this point in time. People are rapidly going to move and are beginning to, and you can see this in the outperformance of the Dow versus the NASDAQ, for example, that people are going to take risk off the table. They're going to care more about the return of their money than the return on their money, the classic Mark Faber argument. And for that reason, I think gold is the only one-way trade in the markets right now. It used to be the Japanese yen carry trade. It is no longer. And so the big one-way trade is gold. Gold has nowhere to go but up because everyone on the planet, from the Federal Reserve down to you, has an incentive to own gold and want a higher gold price. The Fed needs a higher gold price to fix the problems with its balance sheet. The ECB needs it more than the Fed does. So I would stay away from Europe. Certainly European banks, my God, like who would buy EUFN? At this point, I don't know. I would stay away from the UK because the Bank of England is go read the work and listen to the podcast I did with my friend Alex Craner about the coming collapse of Britain over Ukraine, right? And why Ukraine is actually a Bank of England problem. Okay. And I would be long commodities. I believe we are at the cusp of a commodity super cycle because of all the things we talked about earlier. And I make it very simple. Industrial metals are all trading at their new floors. Those floors used to be their ceilings. $4 copper used to be a sell. Now it's the floor. Same thing in grains. But $3 a bushel oats was a sell. Now it's the floor.
So is $30 silver now the floor?
No, I don't know. And I don't know because there's still a lot of people who hate silver and are still structurally net short silver. That what I would say is
true.
Last week's close, last week's price action, and the follow-through action this week is indicative that something is beginning to change.
Something's percolating for sure.
Yes. And, and this is what I do for my clients on a twice weekly basis, which is to go over, all of these major asset classes that we talk about, and then tie them to the daily, to the weekly events and into the big picture scenario, and do that on a regular basis. And so when I look at the weekly close from silver last week, blowing away the 2-bar, like silver's been doing a series of switchbacks over the last 6 weeks that will make your head spin, right? Is it up? Is it down? It's like, it's like the old Robin Williams joke about Tom Cruise. He lives in a house of nothing but causes. I'm in, I'm out. I'm in, I'm out. I'm up, I'm down. I'm up, I'm down. I can't figure it out, right? And oils, every time oil tries to break out, they just beat it with the ugly stick. So what I would say is, you got to wait for silver to confirm this move above 30 by getting a new high weekly closing price. Go look at the chart. Go look at the last high weekly close. Not the high price, but the high weekly close. Go watch that. When you get a move above that, that's going to be your signal that silver is going to move into a new price regime. And if it breaks through that $31 to $33 area, well, high 40, 45, because the short covering is going to be insane. Go look at Apple. Go look at IBM. Go look at certain stocks that everybody shorted. They did the round number short on. They were doing the same thing in gold at 2,500, and look at what's happened. So when you take into your positioning, and when you're going to take up a position, you've got to know where your timing, what your timing is. It's all about. It's all about timing the market and being. You can be early as long as you're not like years early, but be a little early. That's fine. But then know where your exit position is if you think your thesis is wrong, and then know where your breakout level is, and you accumulate while assets are being sold and suppressed, and then when they break out, you either let it ride and you just and you make life happy, or you take money that's off the sidelines and in losers and you double down on the breakout, and then that's when you make real money in a trade. And that's up to you, and it all depends on you talk to you and your tax professional and all the rest of that stuff. But in general, the strategy is always going to be either get there early and just collect, and hopefully it's paying you a little bit to wait for the breakout, and then move on. And thankfully, the gold industry has finally realized that they need to pay people about 1.5% to wait, and that's better than what we saw in the bull market from 2004 to 2011.
Well, Tom, this has been fantastic. I've really enjoyed our time together today. Thanks for coming on to Metals and Miners, for being so generous with your time and your analysis and your ideas. It's been wonderful to spend the time with you. Would you please share with the viewers any important message you want to leave with those tuning in, where they can learn more about your work and how they can connect with you?
Sure. The first thing is don't sweat the details. They're throwing everything but the kitchen sink at you to distract you and rob you of your reason. This is all chum. 90% of what's going on, of what you read in the headlines, is chum. So when you learn how to read the headlines, you can de-risk. You de-risk the future in that respect by getting rid of your own anxiety and fear, because you can look and go like Mad Max and Fury Road and go, oh, that's bait. That is. They want me to react to that, and I refuse to do it. I watched gold move $50 an ounce today, and I don't even care. My heart doesn't even skip a beat. I could care less. Gold hit 26 the other day. I'm like, oh, that's nice. Like, I'm so over all of it. But what that does is it frees you up to go, what does that mean? I don't go, yay, I'm making money. I go, what does that mean? Oh, and then we spend the time doing that. So that's that. And that's what I do with my subscribers. That's what I do with my Patreon. As often as I can. We have a private discussion server where we talk about all these things all the time. My community is unbelievable. These people are so inspired and so dialed in that they bring the world to me because they don't think I charge enough for what we do. We do a monthly newsletter with a portfolio, the Gold, Guts, and Guns Investment Newsletter. This is on Patreon, which you can find on my blog at tomluongo.me or over or goldgoatsandguns.com. Goes to the same place. And that's where my partner and I, Dexter White, look ahead to the future or try and accurately describe the present to help you make sense of what's happening right now. And I also do, like I said, the twice weekly market reports, which usually run 45 minutes to an hour, where I do bespoke chart reads and technical analysis of the markets and commentary as to what's happening on a regular basis, along with private blogs and everything else. And then, of course, you can follow me on Twitter, where the very worst version of me will show up every day at TFL1728.
Well, I'm going to put up all that information, all the links for everyone to be able to click through. I've been following Tom for quite some time. Guys, if you're not following him, he's got a great sense of humor. He puts up great information, and he's got a very unique worldview, as you heard throughout our discussion today. So go follow him. I look forward to having you back on, Tom, sometime soon. Thank you for being here with us, and everybody else, thank you for watching.
Thank you.
I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews just like this one that we conduct. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read on why everyone should own gold. So head over to metalsandminers.substack.com. Put in your email address to subscribe and receive the free gift on us.